So this is my trading covered calls from last week. I guess just a tiny bit of context. I'm starting a business, so I don't have a job right now and don't have any income. And so my main goal with doing covered calls and cash secured puts is generating some income so I don't have to sell any assets to pay the bills. Fairly new to this, and this has been maybe like my third week doing it. So this is my snapshot from the 18th of October, and these are the trades that I've been setting up. So my portfolio consists of mainly gold, Bitcoin, and some uranium. And I've been, so these cash secured puts here for IBIT is pretty much me moving Bitcoin from my wallet over to Interactive Brokers so that I can do puts and calls or do the options trading strategy against IBIT. Because with Bitcoin, it's not that easy to do it with native Bitcoin. So I've been transferring this over. But yeah, that's basically what I've been doing. I think what worked well is that I've been able to collect some decent premiums through these puts that I've been selling. So I think like these two were pretty good. And while I did get assigned on that GDX one, I think that one was a bit risky. But on the IBIT, I wanted to get assigned because I wanted to buy IBIT and back because I had sold Bitcoin higher before. So that was pretty good.
So you sold it closer to the money, the strike.
Yeah, this one I sold this one very close to the strike, but because it takes a while to get from Bitcoin to Interactive Brokers, right? I have to sell it through an exchange. I have to transfer it to the exchange. Then the exchange has to wire it to my bank account to Interactive Brokers. I had to do all that. So this here looks bad, but it isn't because I've sold the Bitcoin at like 119,000, which is much
Okay.
higher than what the IBIT here is. Like that Bitcoin 119,000 was like IBIT 70. So this is good, me getting in at this.
So for the people watching, right, all the contracts with a P at the end are put. So Flow, I guess for those they were cash secured puts, and then with the C's they're calls. So they were covered calls, right? So
Yeah,
none of
yeah.
these were naked.
No, don't do naked.
Okay.
I think like what I've learned with this is like before I just would have gone, I would have sold the Bitcoin, transferred over to my Interactive Brokers, and then bought the IBIT. But this time I didn't do that because I thought like, hey, I'll just farm the premiums. So I bought this cash secured put while I already had the money on my Interactive Brokers for the Bitcoin that I wanted to buy. I did not buy it, but I bought the cash secured puts,
You
and
sold
then
the cash secured put.
sorry, I sold the cash secured
Yeah.
puts. Yeah, at the money pretty much,
hmm
and
hmm
got assigned. So that was good. Getting
Yeah. So
getting
you
that 100.
basically got $300 off your buying price.
Oh no, the premium is total here already.
Oh, it's multiplied by two already.
So that was pretty good. And then yeah, for these different puts that I bought, the GDX here, this one, that was also good. Went up and didn't go down too much after that. The GLD, this one I also sold pretty close and it did not get assigned. Yeah, so I think these contributed to that quite high weekly ROI that I had in that week. That's nice.
2.6% is great, man.
Yeah. For starting out, I think I just lucked out. I have to say, right, I also got assigned here in these, right? So I had to buy that before. So I think that worked well. What didn't work well is I actually at that point, or the I think the week before, I had a covered call sold for GLD, and I got assigned on that. And then gold went up like 5, 6, I think even 10% from that. There's basically a lot of opportunity cost that I ran away with, and so that's the negative side. I got basically kicked out of my position by being assigned, and then I couldn't get back in. But I think I did quite well by selling at the money puts to collect the premiums.
Oh, yeah, I think the gold price went down a lot today. So if you still have
Yeah,
puts, you should be assigned.
yeah, I saw that. So then, yeah, I think that was good. And then I think like one other lesson learned, and this is really just me starting out. I think I sized my position for some of my uranium too large, right? So I sold covered calls, and then uranium went up a lot as well, like 6, 7, 8%. I got assigned on these uranium, and for some of them, I had sold covered calls for like the whole position. It
Oh,
didn't kill me or anything. It wasn't terribly bad, but I think next time I'll only do like 50% max or 30% max or something. I still have to figure it out, but that's kind of a thing I've learned, that I won't do the full position. Yeah. So I think that's my summary. Year to date, I've been at 4,000 collected in premiums, 22 trades done, and a weekly ROI of 0.84. And that's just the last 4 weeks. And I think that's since I started. And so now I think I'm improving and learning more and yeah, getting better at picking stuff.
And you think you're hitting your goals with 4,000 a week? Sorry,
Yeah,
is it
4,000 a week is
no,
definitely
4,000 a month, right?
4,000 a month so far. Yeah. 4,000 a month would be, yeah, would be good. That's like 8,000 Kiwi dollars. That doesn't pay like all the bills, but at least pays rent and a good chunk of the rest. So if I can
And
keep up
what's
with that, that'd
the,
be awesome.
yeah. And yeah, I think it's pretty good. So the capital at risk number that you have here, that
That's
145K,
pretty accurate.
would that be about how much you think you're deploying
Yeah,
into this wheel strategy?
yeah. At a time, yes.
That's pretty good, yeah. Yeah, so then 2.6, that's roughly 2.6%, yeah.
Yeah,
You get 4K.
yeah. Yeah, I'm pretty happy with that so far. I mean, it still needs to be taxed and all that. New Zealand is taxing options trades as income. But the cool thing with that is, since I don't have any other income, I'm in a pretty low tax bracket until I reach sort of what I need for the year anyway. So that is not too bad. I think I'll end up around between like maybe 20 and 25% tax, worst case.
Okay, nice. So should we look at what we're gonna look at for trading this week?
Yes.
I'm excited because the market moves have been massive, so maybe the premiums will be too.
Premiums will be too, yeah. Let me share this.
And this is daystoexpiry.com.
Yes. And I guess like the reason why we started or built this is that Jason knows how to do this. Like he's a pro in fiddling with interactive brokers and the app and finding the right things, but I'm definitely not. And when he told me about this strategy and kind of got me on board, I thought I needed some more guidance on how to pick stuff. So I guess what I've done this week, since I've got assigned on a bunch of these puts, I've been selling calls. And so the way I looked at that, let's say I've got assigned on some GDX, so I have some GDX, and I now go and I find calls. And what that will do, it'll take these different parameters. The assignment risk. Assignment basically means the chance of having to sell, or the probability of having to sell. So in this case, we're looking at the current price of GDX is 72. The tool suggests buying a 76 strike option expiring on Friday, and then calculates an ROI, tells me, okay, that would be 1.79. My goal is to be maybe somewhere at 1%. I'm below that on average right now, but last week was pretty good. So this would be something pretty good to have. I'd need to own 100 shares of GDX to do this. And then, yeah, I can just basically take this strategy and find it in interactive brokers and execute the trade. And so I've added this one because Jason thought it would be really useful. I think it's actually pretty good. So the 7-day ROI would just be over a time frame of 7 days. If you did this strategy with 7,600, you'd collect $56 in premium. That's an ROI of 179 over the 7 days. But if you get assigned, then the ROI is actually much higher because the stock price would appreciate it by 4.8% to hit the strike price. So yeah, I think that's also interesting to see.
Because if you do this, then you catch the trend. Then that assignment ROI really turbocharges your returns.
Yeah. So what I did this week pretty much was just I was reacting to what my portfolio had, right? So if I got assigned to GDX to buy GDX, I started selling covered calls on it. And my goal here was to not go too close to the money, so to be a bit out of the money, maybe like 5%,
Yeah.
to make sure that I can actually capture these higher yields if gold goes up further.
Yeah. I mean, to me, it's really attractive that you can still get more than 1% over that 7-day period and still have that chance to capture that 4.8% capital gain.
True. Yeah. So I guess like that was my strategy, was just reacting to what I had in my portfolio. So on Monday, when the market opened, I basically went through all of my portfolio and checked, okay, where did I get assigned on puts that I sold? So I now have these stocks in my portfolio, or where did I get assigned on calls that I sold? And I now have cash in my portfolio. And then I just tried to get back into the position that I had to sell, and started to sell calls on the positions that I bought, and
Yeah.
just use the tool to kind of find the highest one, made sure that I'm not overexposed on them. And in general, for cash, so here for the covered call, when I search, I typically go for the default 25% assignment, because that gives me a decent ROI these days with most of them. But when I go for a cash secured put, so let's say I have that, I go for much higher, because I'm willing to, farm the premiums more, because I mainly want to get back into the position. Yeah, typically, if I really want to buy, right? If I want to get like a really cheap entrance, I'd maybe gamble a little bit. But I don't know, how do you do that, right? Because you don't really know if the market's going to make a big move or not. And if it's going to make a big move, then you want to get in early. If you think it's going to go sideways, potentially a bit lower as well, you could go for a lower strike.
Yeah. I don't know. For me, I've changed a little bit the way I've constructed my portfolio, where I basically focus only on the premium, really. I don't care whether or not I have too many of the shares to catch the uptrend. I try to use some out of the money call options that I'm long to capture the trend. So I still try and aim for that 1% a week either way. And so I just go as much out of the money as I can, both on the puts and the calls, so that I can get that 1 or 1.5% a week premium.
Yeah, so you would actually decline a trade like this as being too risky, because it's so close to at the money. You would be willing to go a bit lower to get that 1 to 1.5% ROI.
Yeah. Well, it doesn't depends, right? Because I have upside exposure with my long calls. So say I've got some, I don't know, 18 months out GDX $100 strikes, right? So then I've already got some bets in place for the uptrend of GDX if it were to happen. So I'm not so concerned about making sure I own the stock. So
So
then
you can really do that real strategy because you don't care. You're just doing it for the
yeah,
premiums.
yeah. And then
But then you
by
can almost
me,
like always sell at the money, right?
yeah, but I don't know. I feel like for me, the way I trade, I feel more comfortable when I'm out of the money getting that 1%. And if I do get assigned, I feel comfortable that I got assigned at a discount to the week before, right? So
Yeah.
then, because then when I then sell a covered call, I don't have to sell so far away. For example, GDX just a few days ago was $80. So if I had of sold a put at $80, I would now be owning GDX at 72.50 with my buy-in price at 80. So then I'll be stuck, right? Because then I'll have to now sell a covered call at 80 just to get my money back. And that doesn't get me much premium anymore. So that's why I like to give myself a bit of buffer, so that when I do get assigned and I do own the stock, my covered calls can be at a price that is at or higher than what I bought the stocks for.
Yeah. So you have a bit of that capital gain.
Yeah.
But where's the sweet spot then? Is there a formula for the sweet spot?
I don't know, because I feel like the sweet spot depends on what your goals are for the trades, with what capital you have and what ROI you need, right? So for me, 1% a week is a nice target for me for income. So I'm happier when I can have some buffer and make that 1% a week. So I have more out of the money or space and still get that 1% a week. Of course,
Yeah.
if things change and you need to generate more income, then you have to go closer to the money, or you need to find other vehicles that are more volatile, you know, like if let's say we're not talking about GDX, or let's say we were talking about GDX a few years ago when the prices were much lower and the volatility was less, it was just basically bottom feeding, then it'd be very hard to do this strategy with GDX because there's not much, the volatility was much less than today. So you would have
So
to
really low.
work a lot harder to try and get that 1%.
Yeah, yeah. So I guess that's what something that you'd be looking for in the stocks that you hold. Would you then switch into other stocks as well? If, let's say gold now trades sideways for the next half year and nothing's happening much, you'd
Yeah,
probably then
I
have to
would.
move out of that into something else, right? That
Yeah,
has higher volatility.
yeah. But also something else that I wouldn't mind holding or would like to hold with high conviction for the long run.
Yeah.
So at the moment, there could be other, you know, it could be Bitcoin, it could be uranium miners, it could be Chinese equities, stuff like that.
Yeah. Yeah.
So that's why I like the raw comparison mode with the covered calls, right? So if I put in a bunch of different sectors, you know, like IBIT, GDX, maybe FXI, which is the Chinese equities, I think they're not very correlated to each other, which is, I mean, at this point in time in the markets, nearly everything is correlated. But let's say the correlation would be less than GDX and SLV, right? Like a gold mining and a silver ETF, they would be much more correlated than, say, Chinese equities and gold miners.
Mm-hmm. Yeah.
So yeah, then I would look at this and see which ones, you know, like at 10% out of the money, I can still get pretty good ROIs on some of them, right?
Mm-hmm.
And then maybe I would go 10% out of the money for the first two, and then the last one maybe go at the money if I need to, or 5% out.
Yeah. Yeah. Okay. So, I mean, that could be a good formula then, right? You look at, okay, I'm directionally interested in these 5 things, stocks, ETFs. And then you do this and you find this and then you just do the simple comparison of, all right, FXI is not going to get me there, but this one is. Yeah.
And sometimes, you know, like if you look at it here, I think you have to be careful also because the tool would pull out the closest strike price. So if you look at FXI for 5% and 10%, they're both 38.5, right? So I would then use that as a, you know, I would then make a note and go into the market and really look at maybe a $38 strike instead of 38.50, because then maybe that will get me to that 1%.
Mm-hmm.
Yeah, because I think the tool rounds up sometimes to the closest strike.
Yeah, I haven't really tried out this much, the raw comparison, but I think it should.
Because you see, for both, for all
I mean, it should
three,
give me more. That doesn't make any sense that
Yeah.
the strike price is the same.
yeah. But sometimes it, with the covered
Even-
app, it did that as well. So
Yeah.
all three are the same for 5% and 10% out.
Yeah, that should be the case.
Maybe you can write something that if they are the same, then you go to 15% or 12% or 14% until you make sure that they're different.
Yeah. Yeah. Yeah, maybe it can be like a range. So you have I guess the underlying problem is that the strike price steps sometimes are not matching. So the next one down here might be 57, and that might be higher than what the fixed percentages here are. But I think we could do a better job at approximating what the next one is. Yeah. Okay.
All right. So we'll catch up again next week and then see how some of these trades went.
Yeah. And then we might also be able to look at yours as well, what you were doing.
Mhm.